Good morning, folks. We're going to wait a minute or so as people are rolling in. Right, let's get started. Good morning, folks. My name is Peter Armitage. I'm the founder and co-CIO of Anchor Capital. We live in some very interesting times, and we thought it appropriate after the events of last week to have a quick catch-up with clients and financial advisors out there. So this presentation and webinar is intended to be fairly short. Myself, Nolan Wapenaar, our co-chief investment officer, will talk about fixed income. Liam Hechter will talk about local equities, and then round up with some questions. If you do have questions, please put them in the Q&A function as opposed to the chat, and we can have a chat afterwards. We normally do a quarterly webinar where we have 1,000 or 1,500 odd people registering. At very short notice, we put this together because I think people want to know exactly what's happening to the world out there. And over the weekend, we had close to 1,000 people registering. So, it's a pleasure, and thank you very much for your time. We're going to try to put things in context. One of the most interesting things is we did a very short version of this to a few clients on Thursday last week, and we were talking before, and virtually every single one of the slides has changed. And that's what we're experiencing in equity markets, certainly at the moment, is massive changes day by day. And this is an attempt to put it in context and try to make sense of it all. So I'm going to start with some slides on largely the global equity market, but having a look at tariffs and where we sit. And please, if any of you want these slides or presentations, feel free to contact your wealth manager or financial advisor who deals with us, and we're more than happy to move forward. Right, so this is this is the point. I think Donald Trump has come out of the starting blocks and shocked and surprised everybody, including the people in his own government, with what he's done. But the market has hit back. The market's hit back in a number of ways. And what we're showing here is a quote from Mike Tyson, where he said, "Everybody has a plan until they get punched in the face." So day by day, we're seeing more and more kind of strident tariff announcements, only to be pulled back a few days later. And businesses are left with relative uncertainty as to where they stand. Over the weekend, I was listening to Jamie Dimon's results commentary, and we really enjoy listening to the results commentaries and question and answer sessions of the big US investment banks, because they basically are right at the coalface of what's happening. And Jamie Dimon was saying on Friday night that what they're experiencing is just a complete pause. Anybody who is going to do mergers and acquisitions or build a project, if you don't have certainty, you're not going to deploy long-term capital. So I think one of the certainties that are going to come out of this is a slowdown in economic activity. I think there's a lot of noise. A presentation like this, there's no point in trying to analyze last week's tariffs and yesterday's or tomorrow's. I think we're going to land up with a tariff regime with higher US tariffs. But one of the things that certainly we're going to look back on was this a time where people lost confidence in the US in terms of the certainty of investing there. Nolan will talk about the US 10-year government bond, which is typically considered the benchmark for pricing of assets and the pricing of money around the world. And the moves in that seems to indicate a bit of a lack of confidence. So the picture on this slide depicts Donald Trump at a sewing machine, which I think is quite apt. And the point is, does the US actually want a lot of the jobs that they've outsourced to the rest of the world? You can't picture a room of middle-aged American men and women sitting at sewing machines, as I would have experienced walking through the biggest textile company in China a decade ago, where literally it was a kilometer long with people 10 deep churning out shirts for the American and other markets. I think the key message that we want to get across is while the volatility is enormous, the actual aggregate moves that we've seen in markets are not that unusual. And these things take, a few weeks or a few months to bottom out. I think if you look at all the times previously when the markets come off sharply, it doesn't just go back up in one day. And the events that we're talking about are kind of a week old. So we're not panicking. We haven't felt compelled to kind of do wholesale sale of shares. I think the actual share moves in aggregate, as we'll show you, are not as dramatic as you would think or as it feels. And that's because the day-to-day moves are so big. But we're having big days followed by big up days, followed by big down days, and the market just trying to find its space. I think a good way to, if you take a step back, a good way to look at this is view it as a growth scare. We went through 2 or 3 decades of globalization where things got produced in the place in the world where they were the cheapest, and sophisticated supply chains brought them all together for a final good. That's being reversed, and deglobalization is happening, and that will tend to result in lower growth. And then there was this term called US exceptionalism, where people were saying the US is just superior to everybody else in the world. The dollar's been very, very strong for probably the last 5 or 6 years or even more. And when anything disruptive happened in the world, the US was viewed as the safe haven. Now that the US itself is causing the trouble, that's being questioned. And as I'll show you in a chart to come, the most significant thing for me that's actually happened, or certainly one of the most significant, is the movement in the US dollar. So that's the world effectively saying they'd rather have their money denominated in another currency for the time being. So what do the tariffs mean? It means higher inflation. Obviously, and really, if you were sitting in Apple's boots last week, Apple produces 90%, imports 90% of its cell phones. And if they really were facing a 145% tariff of bringing their goods into the US, that would mean the $1,000 phone going up to well over $2,000, which would obviously have massive ramifications for their competitive position and the ability to generate gross margins going forward. On the weekend, Trump came through. Obviously, lots of phone calls, I would imagine, from iPhones through to Donald Trump and his partners in the US government. And over the weekend, they came through saying that, there wouldn't be those same tariffs for electrical goods. Because obviously stuff that isn't being produced in America or can't be produced in America, it doesn't make a hell of a lot of sense to put massive premiums on there. So if people have to pay more for goods that are imported because of the tariffs, that results in higher inflation. Higher inflation results in higher interest rates. And that typically results in lower valuations. Why is that? Because if inflation is higher, the value of a dollar in a few years' time is worth less today than if inflation was lower. So you do tend to get a correlation between higher inflation and lower valuations. I think also very importantly, and we'll show you some charts, the market started the year pretty expensive. I think for those of you who follow our navigator and the communications that we send out, we have a very cautious approach to the market, saying that if the Goldilocks story doesn't pan out, the price for errors can be quite big, and that's exactly what we've experienced. But I think underlying all of this, our richest clients and the ones who've got billions of rands of valuation, there's a common theme between them. Most of them have tended to invest in great companies over time and stick with them through these market ups and downs. If you're feeling uncomfortable and the market comes off, any inclination to sell and crystallize losses is generally the wrong thing to do. And what our analyst team is doing very actively is weeding things out and trying to find the opportunities, in fact. So, we're having a lot of what we call beta 1 events. So beta 1 means kind of everything moves at the same time. And there's obviously some companies that are worth a little bit less because of a changed future, and others that are unchanged. But if they've all fallen the same, some nice investment opportunities exist, and some great companies are down about 30%. So what happens next? The US first quarter 25 earnings season started on Friday with the banks. Most of them came out with quite positive statements, not just kind of wait and see type approaches, some caution that economic growth will slow. And that's, I think, the certainty that's come through all of this is you're going to have slower economic growth in the States and probably in other countries in 2025 and 26 than you would have otherwise had. You must remember if you're sitting over in Europe, a lot of the equity markets of there have done a lot better. But the euro is now 9% stronger against the dollar. So besides tariffs, if you're exporting into America or the rest of the world, your prices are a lot higher. So that puts a lot of pressure on. And the guys in China will be discounting because they can't export into China. So it's not just the US impact that's impacted, it's the rest of the world as well. And then something that we've forgotten completely, but one really shouldn't, is that artificial intelligence stories of the last few months, headlines, you haven't heard anybody talk about for quite some time. So that's going to be a tailwind for equity markets. I think there's going to be a lot of productivity improvements, and we don't know how material that will be. But it might be a good time to be positioning in companies that have that benefit coming through. I think then to start putting some numbers up, this is just a breakdown of US GDP and imports. So US GDP is $29 trillion. And to put that in context, I think first of all, to understand that services are very big in the US, and goods are about $6 billion of US consumption. So US is a consumption economy, with about 6 of the 20 being goods, and about half of that is imported. So if you see the 3.2 trillion of the 6.3 trillion, 50% of goods that are consumed in the US are imported. And then if you break that down further, about 60% of those imports come from 4 countries. And that's the European Union, China, Mexico, and Canada. So not surprisingly, that's exactly where Trump has been focused in trying to either get more money from tariffs or ultimately change the mix in terms of what's produced outside of America's borders and what's within. And this is also a graph that really stood out for me. And to understand, we talked about tariffs having an impact on inflation. What's important to understand is inflation is a rate of change every year. So what this graph shows on the left-hand side is that inflation's kind of just above the 3% level, and the prior estimate was it heads down to 2.5% over the course of 2 years. But if there's a once-off tariff impact, it then results in a higher price. The following year, there isn't another positive impact or increase in inflation because of tariffs. It's then in the price level. So this is kind of what people are trying to get their heads around, is while inflation can kick up, the tariff impact of inflation will tend to be a once-off impact, which then starts to come down again. And that's really what, for the bulls, it's to say that, sure, we're going to have higher inflation for a time period, but then it comes back down. So the big moves in 2024 have actually been, we put the equity market here, but gold has been the big one on the plus side, 22%. That's obviously considered a haven. The Mag 7, which is the big tech companies. And ironically, it's only really Tesla and Apple that are that impacted by tariffs there. A lot of them provide services. The S&P is down 10% in 2024, and very significantly, because a 1 or 2 or 3% move for a currency is significant. The US dollar has decreased by 8% in 2024, which is a dramatic move. There's an argument that Trump wanted the US dollar a little bit weaker, but obviously makes your exports more competitive. But there's a point at which it starts to become damaging and can create dislocations in many other ways. And with the expectation of slow economic growth, oil is obviously kind of a bellwether commodity to look at, and that's down 13%. So while the equity markets, the world index in dollars is only down about 6%, and that's partly because stuff that isn't in dollars, so like European shares, have actually done quite nicely in dollar terms. You can see a severe dislocation of many of the parameters that one sees around the world in terms of economics and the like. So this is putting the market in context. So the current S&P level is 5,363. And most people look at things on a year-to-date basis. It's a fairly arbitrary number. But we started the year at close to 6,000, so we're down about 10%. From a year ago in US equity markets, we're still up about 6%, and from the beginning of 2024, up about 12%. The market's down about 13% from its all-time high. So, while we've seen these massive headlines and massive anxiety, these kind of moves happen. You typically get a 10% move in the market most years. And it's very difficult to forecast exactly where it goes from here. And that's because a lot of what's happened is man-made. And when we say man-made, really made by one man. And it's difficult to forecast what happens next. There does appear to be some more sanity coming into the system, but there's a war that he wants to win. So things have become a lot less stable. You could easily see the market up or down 10% over the course of the next few weeks based on their actions. So we'd be looking at drops below 5,000. We'd be looking at selective shares to buy. To give you a feel, if the market went to 4,500, I think you could pretty much buy with impunity from a valuation perspective. But the point is, the market started the year quite expensive, and it hasn't fallen as dramatically as one might assume. I always find it useful to look at pull back a chart. This is the S&P over 5 years, and you can see a general nice upward trend. We had a downward move in 2022. And the equity market's been charging up quite nicely for 23 and 24. And the dip that we've had doesn't look that dramatic in the context of this chart. But I think the steepness of it indicates the extent to which people were taken by surprise. And you can see at the bottom, this is kind of the end of day. During the course of just last week, the moves were Monday 8.5, Tuesday 7.3, Wednesday an up market of 10.8, one of the biggest up days ever, Thursday 4.7, and Friday 3.1. So, market players really confused as to the way to look. At times like these, if we own shares for you, we own quality shares. We own shares that should endure through these, these bumps. We'll look back on this, and this will be an event that too has passed. And, we're getting down to levels where we start to look for opportunities. Then just looking at equity movements in context, these are all the equities around the world. And again, if you want these charts, give us a shot. We obviously can't consume them all, but I've circled what's happening out there. So because the dollar's weakened by about 8%, everything in most of the European markets are up and up quite nicely in dollar terms. So developed markets as a whole are down 6%, and the US market is down 8.5%. This is at the close on Friday. And you can see where the pain's really been felt on the right-hand side here is in the communication and IT services. And that's really where the Mag 7 sit. And this is the valuation chart we were talking about. If you read our commentaries at the beginning of the year, we were saying this is the S&P forward PE multiple. We're sitting at around 21, 22 times. And that, measured by history, was pretty expensive. So it was pricing in a pretty rosy future. And it's not a great place to come from, if there's going to be a growth shock. So you can see we've gone down to about an 18 multiple. Another 10% down would take you down to the average of the last 20 years, but certainly below average for the last 10 years. So despite what's happened, shares are not yet cheap. It would take about 10% down more for us to be pounding the table from a valuation perspective. Bonds year to date are up about 3.8%. So they are to a certain extent playing the counterbalancing role that one would expect in a balanced portfolio. But the last few days have seen some jitters in US government bond markets where people are saying, this is supposed to be our haven and our place of safety. But the States itself is creating havoc there. And then this is the currency chart that we were showing about year to date. The US dollar down 7.7%. It's a dramatic move for a currency, massive implications for importers and exporters. And, that's got to be balanced against the tariff numbers. Imports are now quite a bit more expensive for the US simply because of a weaker currency. And against that 7.7%, the strongest currencies have been the Swiss franc, the euro, and the Japanese yen. The South African rand feels pretty weak, but it's only down 2% for the year against the dollar. But of course, that big move between the dollar and the euro. So we are down about 10% against the euro. If you go on your European skiing holiday, it's suddenly about 10% cheaper than it's more expensive than it was the week before. And then quite a lot of pressure on commodities across the board, with Brent oil being the big one. And that's down 13% in the month of April. So a massive move. And that's based on people's expectation. Obviously, if the global supply chain gets disrupted and less goods are moved around the world in terms of the globalization that's happened over the course of the last while, less fuel is going to be needed. And then the big move has been obviously in gold, where year to date up 23% and up to 39% over a year. So that, folks, is my summary of the equity market and how we see it. There's lots of moving parts. Things are changing by the day. The key is to be invested in good compounding companies with moats and companies that can endure these issues. We think we are, and in fact, I think over the course of the last week and during this week in our model high street equity portfolio, we're adding some Ferrari, and we think a great quality business. It's been too expensive for us for quite some time, but we really loved it. We've been looking at some US gambling companies, DraftKings and Flutter, and we're sifting out, looking for the opportunities that the market brings to us. In our job, often you can't decide that on any particular day you're going to go and find a company to invest in. We cover, quite closely, probably 100 global companies on our watch list at the moment. And it's a great opportunity when the prices come to you. It's a company that you like, but the price starts to match the entry point that you'd like and that you think that's attractive. So that's the equity market. I'll hand over to Nolan, who's going to talk through fixed income. And as I said, put some questions in the Q&A if you want to have a chat.
Thank you very much, Peter. And hello, everybody. It is really appreciated that you've dialed in to sort of get an update on how we're seeing the market and how we are reacting to these recent events. I think, I have introduced myself before, and Pete's introduced myself, but I'm Nolan Wagner, and I am Co-Chief Investment Officer at Anchor, but really I'm responsible for everything that pays interest income, in other words, fixed income. And if you look at what has happened over the last few days, this really started with the markets trading and treating this like your traditional growth shock. And in your traditional growth shock, what you see is equity prices go down, but the counterbalance is that bond prices tend to go up. So as a fixed income investor, that gave us a bit of an opportunity to look at, where do we see opportunities to invest? How can we reposition portfolios? And equally, the bond markets can be a little bit technical, and that means we can actually get a bit of a read as to what the market is thinking from them. So I'm going to walk you through that for the next few minutes and then hand over to Liam afterwards. In terms of where this all started, it started, if you remember, with Trump's idea of reciprocal tariffs. And he stood in the White House with this table, was actually on a big sort of placard that he was holding up, saying these are the tariffs that they're introducing. And you've got China right on top. In those days, it was 67% tariffs. It has obviously increased since then. And you've got South Africa there with our 60% sort of a bit further down. So one of the first questions that came out is, well, how did you get that 67%? So what happened was the Office of US Trade Representatives put that formula on the left-hand side out. It's actually still on the website if you go and look, and it's got about 2 pages of information as to what that formula means to explain what, where these tariffs came from. Thing is, that formula is a bit of bluster, and it's actually, a lot of it is just a PR exercise. So let's look at where the tariffs really came from, and then let's talk about what that means. So on the right-hand side, the Office of US Trade Representatives for all of the major countries as well lists the trade relationships. And if you go and click on a particular country, and we've picked China here because it was top on the list, if you remember, 67% tariffs. But what you will find is you can actually go and look at the trade relationship with that country. And just reading it, US total goods trade with China were estimated at 582 billion, and exports to China were 143 billion. US good imports from China totaled 438 billion, and that left us with a trade deficit of 295. So what you can actually do is scrap that formula that they published, and instead you can go and take this statement from the Office of Trade Representatives. You take the trade deficit with China, that 295 billion, that becomes the numerator on the left. And then you take the sort of total goods traded or imports, which was 438. That becomes your denominator. You take the trade deficit, you divide it by US imports, that will give you 67.3%. That is the 67% that was on Trump's placard. And if you go and do that for any individual country, you will actually find that is exactly where all of the numbers came from. So it's just the trade deficit in goods divided by US imports. But that created a lot of issues, and it actually irritated a lot of the trading partners, because why are we only looking at goods imports on deficits? What about services? What about if Anchor pays its Microsoft license, that goes to a company out in Seattle, and that is, trade between South Africa, if you want, and the US, but that gets excluded. Why is it excluded? And a lot of questions around that. The other questions that arose, well, what about, unusual imports or things that can't be produced in America? For instance, South Africa mines platinum. The US needs platinum for semiconductors. It needs platinum for motor vehicles. But there's no exemption for platinum, and it was included in this calculation. The 60% tariff that is imposed upon South Africa, or calculation, actually came from or includes platinum. And then afterwards, there's an exemption that was created, but the rest of South Africa's goods are now being having duties levied at a higher tariff because of our platinum production. There are all kinds of quirks and questions. So a lot of politicians are looking at this going, how do we logically argue against what has happened here in a world where logic doesn't seem to make sense? It's not necessarily a particularly logical approach. And that's part of the frustration that the rest of the world has had, is it did feel a little bit whimsical. So from that perspective, it started by getting a lot of people's backs up. It started by irritating people, and has created a massive concern within the US. But looking at the US impact itself, the best way to look at it is if you look at the Chicago Metals Exchange. They run a derivative sort of trading desk where fund managers throughout the US are able to bet on where interest rates in the US will be in 12 months' time. So what you've got here effectively is, starting on the right-hand side, you had 0.5% of fund managers betting that there'd be one interest rate cut in the US in the next year. 4.9% betting there'd be 2 interest rate cuts in the US, 17% betting on 3 interest rate cuts, 4 interest rate cuts, 5 interest rate cuts, 6 interest rate cuts, etc. So that kind of gives you a good sense at any point in time as to what the market is thinking the likely outcomes are going to be. And clearly, the market started pricing in increased interest rate cuts. But now, interestingly, if you think about interest rate cuts, when is the US Fed going to cut interest rates 6, 7, 8, 9 times? Well, to be honest, that's pretty extreme, and they're going to be doing that in extreme environments. In other words, when the US is in recession and they're playing catch up. So you can actually take the probability, or the number of guys betting on different scenarios, and you can kind of break it down into how many people are betting on a recession, how many people are betting on a sort of strong economic slowdown where US growth sort of doesn't quite go below zero, but gets kind of close to it, and how many people think this is going to work out okay. And this particular chart that I've got up in front of you is one from just after the tariffs were announced. And what I'm showing here is that we went from a scenario where almost no one was betting on a recession. In fact, I think it was close to zero. Suddenly, within the space of 2 or 3 days, almost half of the market was betting that the US was going to go into a recession. And this had massive, massive implications on investment portfolios. If I look at what this looks like today, so this morning's chart, this has now gone back the other way. And people have tempered their expectations of the slowdown. About 7.5% of the market is still betting on a recession. And most people are saying, yeah, we're going to actually have either a significant slowdown where growth pulls to about zero, and that's 47% of the market, or 41% of the market are going, this is actually going to work out okay. We're going to have the perfect landing. Growth's going to slow down a little bit. It's too hot anyway. Inflation will continue to trend down. We're going to come out of this okay. So you've had this sort of surge of relief from the market that's come through in the last few days. But the point is, every time we see something on Truth Social, which is Trump's preferred sort of Twitter platform, if I can call it that, you're seeing these odds move quite dramatically, and that's creating challenges within the portfolio management environment. Right now, we're expecting things to work out okay. Let's look at what that really means. So here's another chart, and this is again up to date as at this morning. But what this looks at is inflation expectations in the USA. So what we're able to do using fixed income instruments is we can kind of go and pull them apart and figure out what inflation expectations are, how much inflation is being priced in. Now, if you look for the next 2 years, how much inflation were you expecting? You're going to look at this orange line that sort of bounces around a bit. And then suddenly, as Trump came in, started increasing, and that orange line sort of peaked, at just under 3%, come down a little bit since then. And that is talking about what the average inflation rate is expected to be for the next 2 years. And you see that an average inflation rate has never been higher. And that plays very much into what Peter was saying earlier, where inflation is going, inflation expectations are going up. They're going to go up for the next year to 18 months. But thereafter, we expect inflation to roll down, to roll over, and to come down again. Average for the next year, 2 years, is about 2.8%. If we extend the period and say, what's the average inflation for the next 5 years, you get to this blue line, which sort of bounces around where you, over time, then shoots up a little bit, but it doesn't shoot up as far. And it's actually kind of in line with where it was. That is saying that inflation is expected, again, to roll over, and it's expected over a 5-year period. The sort of bump works itself out of the market. We're going to be okay. But the very interesting one is the green line, which says, well, what about further out? What about inflation in years 6, 7, 8, 9, and 10 from now? And again, you can see that sort of bounces around within a range, and suddenly that starts going down. It's actually at the lowest point it's been. What's happening here? So what the bond markets are saying is that, as we all know, as the price of a good goes up, the demand for that good comes down. And the market is saying, as these prices go up, there is going to be less demand for goods. That means growth slowing down. A deglobalization means growth slowing down. Combine all of this, it means that in years 6, 7, 8, 9, and 10, we expect that the overhang on growth is still going to be there, and we expect a slower global economy. We need to adjust for that. So the bond market is saying inflation shock a year to 18 months, and then growth keeps slowing down, and this deglobalization slowdown doesn't come back. We expect it to persist. Think about US bond markets, as Peter was saying. Yields initially traded lower because we thought, your traditional growth shock, we thought that the Fed would cut interest rates. But then there was this realization, but wait a minute, if inflation is actually going upwards quite rapidly for the next year or so, is it really that easy for the Fed to cut rates? And the answer is no, it's very difficult. So from that perspective, the market suddenly went, well, what if the rate cuts are delayed, if they're more difficult? And the bond prices, the yields started going up to say, well, maybe the Fed can't cut rates when inflation is pushing 4% in the next year. And that started seeing a bit of an unwind of the bond market. It started creating a loss in confidence to a degree in the US. I think a lot of hedge funds that were positioned for rate cuts suddenly were closing out those positions all en masse. And that resulted in yields suddenly pushing up. But as we sit here right now, what do I think, if I look at these charts, lower inflation in the long run, lower economic growth in the long run, where do I think the fair US yield is? Probably somewhere around 4%. Where are yields right now? 4.5%. That means I'm going to earn 4.5% on a US 10-year bond. And on top of that, there are potential capital gains up to sort of 4% on these bonds at today's prices, if my maths is right. Suddenly I'm talking about an instrument that could yield 8.5% in dollars at a time that markets are a bit volatile. Bonds suddenly become quite attractive for investors as such. Turning our attention to domestically, I've had this chart up a couple of times, and what we've often said is domestically it's been about the government and national unity, the shocks to the government and national unity, and that overwhelmed, if you want, the tariff impact that we were seeing in the rest of the world. This is a chart I've used a few times, so I'm going to introduce it a little bit more quickly. But what you're looking at is the buildup of the components of where the yield is on South African bonds, on the 10-year bond. And looking at the bottom, you add the yield on the US 10-year bond. You add a credit premium because South Africa isn't the USA. You add a currency adjustment because we're talking about South African rand bonds, not dollar bonds. But I want to really get to the white piece right on top, which I've said before is effectively our political risk. And that political risk premium at the time of the national election back in June, which is where my mouse pointer was, we said, look, that political risk premium is too high. It is going to come down. We positioned for it. We actually did very, very well for Anchor's investors on that. And that political risk premium was largely priced out. You roll all the way along to when the national budget was declined and when you had the big sort of fractures between the ANC and the DA appear. And suddenly that political risk premium reappeared and it priced it in very, very strongly. You can see that the market was very concerned about the possibility of a permanent divorce between the DA and the ANC. After that, we had the press conference from the ANC, which said, look, we're going to try and do government and national unity take two. The first one was rushed. We need better rules. We need better ways of dealing with each other. And the market sort of sighed a sigh of relief. And you can actually see that political risk premium priced out. It priced out at exactly the same time as the US bond yields were going up. So you didn't necessarily see it as much on the bond perspective. But what I am saying is that the South African bonds are sort of saying, yeah, we think it's going to be okay in South Africa now. Finally, pulling it all together, just to comment on the rand, the South African rand has traded a lot weaker on the back of this. I think the initial primary driver of this was government and national unity concerns. Obviously, there's also the global spillover from tariffs. As we sit here right now, the dominant factor that I'm seeing is this theme that is taking hold of a weaker dollar. I'm seeing analysts out there talking about the dollar weakening further from here. It's already almost 10% weaker than it was against the euro. Analysts are talking about potentially another 10% weakness on the dollar. Sitting here as a South African measuring our rand, if the dollar does weaken 10%, theoretically, if that was a one-for-one relationship, we're talking about the rand recovering to 1750 thereabouts. The reality is it's not a one-for-one relationship. We do have other internal issues that we still haven't fully resolved. We do have an overhang from the national budget that's going to be there for a while. And as our trade diminishes with the US, whether it's for tariffs or other reasons, it's going to slow the rand recovery. But from where we're sitting, we are talking about the rand recovering some lost ground. It's already started doing that. Anything down to sort of 1850 level is very plausible. Below that, I think we'll need a few things to go right. But that brings me to the end of the section on fixed income. And I am going to stop there, wait for questions. And I'm going to hand over to Liam to talk about the domestic equities. Thank you very much.
Thanks, Nolan. Assuming screens sharing correctly. Okay, yeah, as Nolan suggested, I'm going to chat about the domestic equities in the context of everything that's going on. Quick intro on myself. I'm Liam Hector. I manage a range of emerging market and South African equity-centric mandates. And I'll just unpack what was quite a wild few weeks. And as Pete said, we gave this presentation a week ago, and we've had to make a lot of updates. I think when we penned a note to our clients 2 Sundays ago, it really kicked off with saying there is no good news out there right now. The domestic news flow was pretty troublesome, considering the just how much positivity had been baked in post the GNU formation, and then also globally there was just a whole bunch of factors that were not really working in South Africa's favor. But before I unpack the last couple of weeks, I always like to show a slide just to show what we are talking about. So when we discuss JSE equities, it's not necessarily just pure focus on South Africa. The market is largely made up of a pretty diversified range of exposure. So about half the market is geared towards the South African economy, the domestic outcome, local GDP growth, and the rand and South African bonds and the like. And then the other half has really got very little to do with South Africa. Some of the business have operations in South Africa, but they export, like the miners. And then you've obviously got the large, diverse, globally diversified rand hedges out there. So there's a number of push and pull factors that take place on the JSE with regards to macro outcomes, like what's going on in the US and other parts of the world, China, emerging markets, and then the stuff that's really impacted more broadly by local happenings like local politics, the GNU and the like. So in terms of where we started, so call it 2 weeks ago, call it the beginning of April, end of the first quarter, South Africa was one of the better performing markets globally year to date. So at the end of the first quarter, the JSE in dollars was up about 9% and MSCI World was down. That was largely a continuation of a trend that really kicked off, sort of end of May last year after the national elections. And that trend really continued right up until the end of the first quarter. The domestic part of the market initially had taken it higher, and then interestingly, the gold sector really came to the party in the first quarter of this year, adding almost close to 100% of the gains for the index for the year. Was that just a little corner of our market that's got gold exposure? So the JSE actually looked pretty good. While below the surface, you started seeing some weakness coming into the banks, into the retailers, after a very strong run that they had last year. Bring us forward to the beginning of the second quarter, and we had what was really an absolute perfect storm to hit the JSE. So on Tuesday 2 weeks ago, it was a fairly ordinary trading session, but there was certainly some murmurings around whether or not there was going to be a budget passed on the Wednesday evening after the market closed, and that started building into quite a negative rhetoric that really started setting in, and you started seeing serious weakness across the particularly domestic parts of our local market, and it was held or maybe masked a little bit by the fact that the exporters and the miners were pretty strong over that period of time. So at an index level, the outcome was fairly ordinary. But there was certainly you could start to see the market was pricing in some issues regarding the longevity and durability of the GNU and how the DA was going to approach the VAT hike or the VAT increase that Nolan, I think, alluded to earlier. So that took us to about Wednesday. After the market closed on Wednesday, you then had the votes that came through. They managed to pass a budget without the DA in it, which was perceived to be very negative, certainly from our perspective, because all of a sudden brought into question whether or not that there still was a government of national unity, and it all of a sudden, the risk of serious political turmoil in South Africa after a period of, I would say, quite a positive period for about 9 months following the formation of the GNU. All of a sudden, that was brought into question, and you had to start planning scenarios as to what could take place if there was a dissolution of the GNU. That happened at the same time that then on Wednesday night, quite late in South Africa time, Trump came out with the press conference that the guys have been speaking to earlier, and it really resulted in a perfect storm where the domestic part of our market was hit by internal factors, GNU related, and then also external factors that started knocking global equities. And that you saw quite a sharp reaction in our local market. There was no sector that was spared, and the market was down 3.5 or 3.7% on the Thursday, another 5.5% on the Friday, and really that was when China started responding, and it became completely clear that there was going to be an all-out trade war, particularly between the US and China. There was all of a sudden the export sectors on our market, bulk miners, industrial commodities, and the like, that have a quite high correlation towards global growth. All of a sudden, they started underperforming, and then you also had the the added impact of our China exposure on the JSE, direct sort of through or indirect through Naspers and Tencent, which started breaking down quite heavily. So you've had quite a sharp response at this stage, and over the weekend, as we had gone through all the information, markets weren't open, and we sent a note out to clients. At that stage, there was absolutely no good news, but certainly there started to be some kind of murmurings around some pragmatism that had crept into the local political situation. I think there was an interview with Helen Ziller that really allayed fears around the DA stance and their willingness to pull out of the GNU. So you started to feel like maybe the sands were shifting a little bit, but when markets opened on Monday, it was an absolute bloodbath, and they were down about 6% in the futures market just before the JSE opened. That took us to about a 15% index hit over 4 trading sessions. Usually there are big counterbalances in our local market, where if it was just purely a GNU issue, the currency would weaken and you would get some kind of index support from your exporters. South Africa's got quite a big component of rand hedging across the index, but this time there was absolutely nowhere to hide, and it really had quite a dramatic impact on our index, and that all happened over a very short space of time. Fast forward to today, 1 week, call it 1 week later, we all know that there's been, Trump, it seems, has reached this pain threshold and what the impact on their market was. It looks like the GNU, it looks like it's been pretty much saved on when it was pretty much on the brink. Whether or not it was global market forces that resulted in the local politicians coming to the table and acting in a far more diplomatic fashion, we'll never know. But the GNU, as we sit here today, is still intact, but it's been brought into question. So I just decided to make a slide to say where we sit today, what's changed over the last 2 weeks in South Africa. So it really kicked off with the durability of the GNU being brought into question. That has been de-risked. So we can sit here to say that what we have in front of us today is not as high risk as it was a couple of weeks ago. But at the same time, investor confidence has properly been shaken, because all of a sudden there's a more than zero probability that this is going to happen again. And I don't think that was baked into many asset managers and their positioning in the market leading up to that. Where we sit today, the South African bonds have weakened, as Nolan spoke to. I think there's a combination of local and global factors that have impacted that, and that is your underpin of how you create values for equities on the JSE, particularly the domestic ones. And then something that started creeping in, I would say, a couple of months ago, but it's really picked up pace, is that South Africa's GDP estimates have followed global estimates lower, and I think we started the year, some analysts forecast, north of 2.5%, quite optimistic, and also, I mean, for a country like South Africa with so many unemployed people, it shouldn't actually be that difficult to try and achieve that. There's a lot of underutilized capacity in our economy, so there certainly was a reform narrative that was building. But then that seems to have stalled since the start of the year. I think we certainly started the year north of 2% on GDP growth estimates. I think we're probably somewhere at 1.5, 1.7% now. And as of this morning, JP Morgan has actually just come out, and their strategist has reduced South Africa's GDP estimate forecasts to 1.3%. So you can see that you are in the cycle of lowering growth estimates. This is not a helpful this is not a helpful set of circumstances, particularly for our local companies, because their earnings estimates really are baked in a much more positive GDP print this year. It is worth mentioning, hasn't been mentioned yet, but there certainly is, South Africa does seem to be caught up in some geopolitical crosshairs. There's certainly some congressmen in the US that have got it out for South Africa right now. And as soon as the word sanction has been brought into the conversation, it's really going to rattle the confidence of certainly offshore investors. And I've just put MTN there because it's the only company we can think of that's ever been sort of mentioned as potentially having transgressed. And then the US dollar. The US dollar has weakened materially, which really masks the rand weakness that you've seen relative to the other crosses. So against the euro, you're down 9%, and against the pound, you're down 5.5%. So that's really what's changed over the last 2 weeks, and the outcome on our local market has been quite severe. Once again, at an index level, very difficult to see the fullness, the full impact of what's gone on, because you've had a continuation of the rally in gold. So gold, I've just in terms of this, I've taken an average across the stocks in each sector, how they've reacted over the past few weeks, and gold is sitting up in the sort of high teens share price performance, and that's really helped the index along a continuation of the trend that you saw in the first quarter. And then at the other end of the curve, you've seen financials the weakest. I see today there's certainly been a bit of a reprieve even across the entire market. I think gold's come down a little bit, and financials have come up a bit. So the financials probably the most correlated to the impacts in the bond markets that you've seen. And then in terms of the context of the pullback, I think it looks quite similar to some of the other global markets. The SA market pulled back very sharply, but has come through some form of recovery. Up until yesterday, a lot of that recovery was in the gold market, which once again hides or masks the real weakness that you've seen across the domestic focused sectors of our market. And then when does SA start to look cheap? I've stopped showing the charts of the PE multiple of the South African index prior to 2020. There was a very different regime. South African equities used to trade, in high teen multiples. Round about the time it used to trade at a premium to global equities, right up until around the time that Jacob Zuma fired the finance minister back in 2015. But over the last 5 years, the market that we've been in, South Africa, it's cheap relative to the rest of the world. It has looked cheap for a long time, but it's kind of back to the levels that we saw before the election last year. And that's really, if you were picking lows on the stocks over the last 2 weeks, in SA, you were pretty much picking, pre-GNU type valuation levels. And I've got one more slide that can just highlight that. So I've picked a basket of high quality domestic SA names. I use a little asterisk there because some of these names are, I look at an ABSA and there's maybe a bit questionable if that's a high quality SA name, but it also just highlights quite an interesting valuation opportunity. And what you're seeing here is things aren't looking completely bombed out, bargain basement cheap. The premium you pay for certainty of earnings and higher quality businesses are still there. You're not able to pick them up at completely bombed out prices, certainly now or maybe just yet. But some names are looking cheap. So if you look at like an ABSA, for instance, forecasting maybe it comes out at an 8% EPS CAGR. Maybe there's a few downgrades to come on the back of these GDP growth downgrades, but you're picking that up on a 10% dividend yield. It's trading cum divi right now, so you could actually get 15% of your capital back over the next 12 months on something like an ABSA. But across the market, there isn't that many valuation anomalies just yet. But yeah, as Pete alluded to, the team is working hard all the time at trying to identify these types of opportunities. As a house, we gravitate towards higher quality businesses. Most of these companies on this list we own in our local equity portfolios. And yeah, I suppose it's just about trying to keep a cool head right now and focus on the longer term benefits of equity investing and the core principles of what we're trying to achieve. Over to you, Pete.
Brilliant. Thank you, Liam. Nolan, if you want to perhaps come back on screen as well. Thanks, guys. Hopefully we've given you some info and feelings as to what's happening out there. And there's quite a few questions coming through. If I can pose to you first, Nolan. First of all, just that inflation graph that I put up to get your perspective. So tariffs are a once-off impact on inflation, but then there's a question posing: does it have a second round effect? So start increasing wage rates, etc. And then, tied to that, I guess, the US dollar, does it start to lose its status as a gold reserve, as a global reserve currency? The 8% this year would have been pretty unnerving for people who always felt very comfortable sitting in the US dollar. Or do the countries just accept that and wait out Donald's presidency?
Thanks, Pete. Two very different questions. Let's tackle the inflation question first. Absolutely, I think it is quite reasonable after seeing goods inflation that we are going to see, people clamoring for increased wages, and all those second round effects. I think the point I was trying to make, though, is at the time this is happening, you are also going to see a softer economy. So you're going to have these second order effects, if you want, pushing inflation up, but you're going to have a slowing economy pulling inflation down again because there are fewer jobs, fewer opportunities, less global trade. And in this tug of war right now, financial markets are saying the economic slowdown is going to win through, and that will counterbalance, the increased wage demands to the extent that actually you're going to see inflation below where it is right now and below the Fed's target. So that's the market interpretation at this stage. But absolutely, the market's got it wrong in the past, could get it wrong again in the future. My inclination is it's probably the correct interpretation. Looking at the US dollar global reserve question, the US dollar has been the global reserve for a long while, but there's also has been for the recent couple of years, 5 years at least, a little bit of a trend away from the gold status of the dollar and looking towards other countries as such. I think what has happened has accelerated this trend. I think the behavior of the US in terms of its treatment of other countries, its policies, people will be looking at this going, yeah, this isn't, the shocks to the market are bad for confidence, and we want to have our global currencies and global investments in currencies that we trust, in currencies that we're comfortable with. So from that perspective, I think it's definitely dented the shine of the dollar. But I don't think at this stage, the trend is over. I don't think it's going to break the dollar. I think that eventually the US will come through this. It's got some great companies that are still going to be great investments. I think that, it just is such a big portion of global trade that while, you've dented it, the dollar is going to continue to be the global currency for a long while yet.
Thanks, Nolan. Liam, you spend a fair amount of your life looking at emerging markets and looking at the China scenario. The most recent story coming through today is China talking about export bans on rare earths, tungsten, etc., impacting US and defense high-tech industries. Maybe just take a step back. That's quite specific, and being able to answer that specifically, I think, is a very kind of niche segment of the market. But perhaps just to, if you're sitting in China, how do you view the madness that's going on? The Chinese market, in fact, hasn't, in aggregate year to date, been that bad. What does China do? Do they start to retaliate by things like rare earths? Have you got any views?
Obviously that development is quite fresh, and haven't given it much thought. But on rare earths, which is quite interesting, and I'm not a mining expert or rare earths expert, but from my understanding is that while China currently produces and mines the bulk of rare earths and rare earth minerals around the world, it doesn't appear as though rare earths is actually the most scarce commodity out there. So I'm not sure the impact of a rare earth ban on the total aggregate rare earth sort of ecosystem, if you want to call it that, globally. I think that there is a way to get around that with additional supply from other places. But in terms of China, interesting, because you've got two forces at play. I always think back to Trump 1.0. Chinese consumer sentiment does get impacted by what's going on between the US and China. There's actually, you start to see it in the numbers in China, and China's coming off the back of a pretty tough tough few years on the consumption and consumer side, and their response to that has been to probably since about September last year announce a raft of stimulus measures, largely focused on boosting domestic consumption. So from our perspective was, we like to invest in businesses, not take these big broad views, but certainly look at the businesses that we're invested in. If you look at our China exposure, most of them don't have direct impact as a result of tariffs. They will have an impact from a consumer sentiment perspective, but at the same time, the policy in China is very accommodative towards trying to boost domestic consumption. So I think our focus is far more on what the Chinese are trying to do to help their own on the ground, and how that impacts our businesses. And at the moment, it looks like they're trying to do quite a lot for them. Yeah.
Then there's quite an interesting question, and perhaps all three of us can have a go at answering it, and I'll start. What, in your estimation, are the likely best and worst case scenarios as this man-made problem plays out? I think one of the ways that I view it is, nothing happens in isolation. And it's a bit like you take a balloon, you press the one side, it's going to pop out the other side. So certainly a lot of the actions that are being taken can have reactions from other countries. And also what they've in the past called the Fed put or the Trump put, or if things get really bad, governments then get forced to take actions to kind of bring things back to the mean. So in the States, you've got the Congress and the Senate, which votes together. Typically, most of times in history, you've had the one house or the one part of government able to slow the other part down. So Trump's put himself in a fairly unique position. But I think also to remember that Trump is voted in. There's midterms in 2026, and the electorate will decide whether they're doing the right thing or not. And I think the biggest thing there is the unemployment number. The real doomsayers are talking about 2 million more unemployed people in the States. If you put it in the context of, I think there's 80-odd million voters, and 2 million is quite, the difference between the states is normally 51-49 or 48-52. The gap between Republicans and Democrats, 2 million is a lot of numbers. And people who've lost their jobs would typically want to vote against the person who they perceive has seen them lose their job. So like we saw last week, there was one day when the market had started to tank. One tweet came out saying that things are delayed for 90 days, and the market bounced 10%, one of the biggest moves ever. So I think that Trump's trying to navigate in negotiating in a way that's almost like playing Monopoly, trying to go to one extreme and then pulling it back. My likely scenario is, so in other words, what I'm saying is there are things that self-right if it goes too far. I think another very important thing is interest rates are very high in America. They're sitting at 4.25%, and the Fed's got a big ability to reduce interest rates to kind of boost the economy again. So from my scenario, a likely outcome is GDP growth in America. The impact of all of this results in economic activity slowing down. GDP growth for a quarter or two maybe heads towards naught. JP Diamond is talking about a 50% chance of a recession. They then want to reduce regulations, reduce taxes, and that's their kind of game plan to bring America back. So I think the currency has moved quite far. Doesn't mean it can't move further, as Nolan's talked about. That's also one of those self-righting mechanisms. So my likely scenario is fairly muted returns from equity markets for 6-12 months. I'd still be there's still lots of shares that you can buy in at very exciting prices at the moment. Like we said, there's difference between indexes and individual shares. Bonds, global bonds, I think can come down to 350 from 425. I think there's, that's nice protection and a possible 10% return from bond markets. But you know, kind of sanity prevails. You've got a 78-year-old president who's radical. I think there's a lot of, you know, in aggregate, Americans are rational people, and I think things will have. I think there is some dent to the kind of globalization story. I think the world has changed a bit. I think people will be less trusting and you know, a bit more skepticism. So I think, you know, slightly lower world GDP growth if you look 2-3 years out. But I you know, I'd like to think the world's sane enough for things to get back onto a reasonable track. Nolan, if you want to have a go at that.
Yeah, it's actually a very interesting question, and I think by and large, what you've described right now is probably my base case as well. I think the reality is that President Trump has left himself 90 days to do 150 global trade arrangements and tariff agreements. Realistically, that's not going to happen. So we are going to be living on exemptions, delayed implementations, but possibly tariffs coming and then going for the next while. So it's going to be a radical period. It's going to be quite a challenging period. But at the end of the day, it's the economy, stupid. Trump can't afford to really blow up the US economy. I think we've already seen that. I think he's realized that he is playing with fire. So he'll be a little bit more cautious for now. I think that means from an investment perspective, you know, more positive scenarios than negative scenarios, if I can put it that way. At the same time, you are going to see a lot of goods from China that probably were routed to the US. The ship sort of suddenly changes tact and goes to Europe. Comes to South Africa, and we're already seeing a lot more Chinese motor vehicles on the roads. And I think that trend will probably accelerate, slightly deflationary for Europe, gives them space for interest rate cuts, possibly a bit more economic growth. Same in South Africa. So I think there's subtle shifts that will give us opportunities for investment.
Leon, do you want to add to that?
The question was, what's the best outcome here?
Yeah, what's kind of a base case? What's your base case?
Yeah. So I suppose from a global perspective, I think just Trump has laid down a template of what he's trying to achieve. I think that they went about it in quite a haphazard manner. I think Nolan spoke about that. So while you know, I suppose we all kind of knew when Trump was going to become president, he was going to attack certain avenues. I think the way that he went about it was in a way that was quite tone deaf to global markets. We look back at the Liz Truss debacle a couple of years ago. You know, what she was trying to achieve, you know, maybe longer term could have been okay, but the way that they went about it resulted in her getting kicked out. There was a mechanism in the UK. I mean, she basically lost her job. And in the US, that isn't there in such a short space of time. But I think the way that Trump went about it was maybe in a bit of a haphazard way. I think he's got incredibly smart people around him, guys like Scott Bessent. So I think that you know, longer term sanity will prevail. How we get from point A to point B is now how they're going to manage the situation. It's incredibly difficult to reshape global trade in such a short space of time. It took decades to build the supply chains that they've got now, manufacturing capacity in different places, transfer pricing, all sorts of things. To try and unwind that so quickly is going to be incredibly difficult. So I would imagine that there's going to be some kind of pragmatism that comes in terms of how they try and achieve that. And then from an you know, investor perspective, as soon as you start to get sort of a line of sight as to how things can be achieved without them looking absurd, which they did a few weeks ago, as soon as you get that and people start having more confidence in being able to forecast more than 90 days, 6 months, 12 months out, I think that you get lower volatility in the market, and you get more investors that are going to be willing to deploy more capital with the correct and appropriate time horizon. So that would be my base case. I think that they're going to go about it in a way possibly that helps make things look a little bit more, you know, or just helps us understand it a bit better. And then locally in South Africa, obviously the domestic political situation is incredibly important, but the SA government needs to realize that picking a fight with the US is certainly not going to help them in any way. And it'll be nice to see, South Africa choose the right people to negotiate with the Americans, and represent South Africa and their interests in the States, because I think that relationship, while it's not the be all and end all from an exports point of view and impact on our local economy, I think it's incredibly important with regards to setting the tone for South Africa and the rest of the world. So that would be my.
Cool, thanks, Liam.
Yeah.
Guys, sorry, there's lots of questions that we're not going to have time to get around to. I think we've gone over our allotted time period. But hopefully that gives you a feeling for what we're doing back at the office, how we're looking at things. And, go and register to get our newsletter. We're having there were quite a few more webinars over the course of the next month or two. Go and get onto our mailing lists through your financial advisor or directly. And thank you very much for your time, and good luck for this week.